Hello, Emerald Peak Solutions investors. My name is Matt Moore. I am a business development manager at CamaPlan Self-Directed IRA, and I'm going to walk you through this presentation right now to go over how you can use an IRA or 401k to invest in real estate. Before I get started, I want to give a quick disclosure that this presentation is not meant to provide investment advice or an endorsement of any kind of investment. It's purely for educational purposes only. We encourage you to touch base with your CPA, financial advisor, uh, attorneys, consult with them before making any kind of uh, investment decision, and do all of the necessary due diligence. A little bit about CamaPlan. We were founded in 2004. We are in the borough of Ambler, PA, which is about 30 minutes northeast of Philadelphia. Carl Fisher and Maggie Polisano founded the company back in 2004, and they're third generation real estate investors themselves. They deal with a lot of financial services professionals, and they know what they like, they know what they don't like. They like having their phone answered when they call. They like people who know what they're talking about. They like getting answers to their questions in a timely manner. And so they've developed CamaPlan to follow that same model. And it's because of this we've been able to establish a great reputation for excellent client service and have a total account number of about 8,000 spread across the country, all 50 states, including the District of Columbia and Puerto Rico. Customer service is highly important to us, and it is the most important part of the business model. So, I want to first talk to you about what a self directed IRA is. And we got to just start from the basics. There's no legal distinction about a self-directed IRA versus the kind of standard IRA that you'd get at Schwab or Fidelity. There's no rules. They effectively operate in the same way. But what is different is that you can have a lot more options in a self-directed IRA in terms of what you want to invest in. So if I go to uh, JP Morgan Chase, where I have a Roth IRA, and I say I want to buy a house, I want to hold it through this Roth IRA, they're not going to let me do that. You need an administrator like CamaPlan who's going to enable you to deploy your retirement capital into a full spectrum of investments and alternative investments that you wouldn't otherwise have access to through a standard IRA at one of those institutions. One of our clients put it really eloquently. Having a self-directed IRA is about investing in what you understand and can control versus using hope as your strategy. And this is an investor who is speaking to his own journey of getting out of the stock market predominantly. So there's still some exposure there, and moving into real estate where most of his portfolio is today. Now, the types of self-directed plans are they're going to be tax deferred and tax free. And the metaphor we like to use is taxing the crop versus taxing the seed. So, taxing the crop means that you are not going to have to pay tax when the money goes into the account. But when you take a distribution, when you take money out of it, you are going to have to pay taxes on it. So, you take on all the risk of investing the money, but the tax man does get to be paid when you take the money out. There's also required minimum distributions. So when you reach the 72 or 73 and you are forced to take a distribution, you will be forced to take a distribution depending on the balance of all of your accounts. So that's also something to consider. Now, on the tax-free side, where you're taxing the seed, the money that goes in is going to be taxed, but when you invest that money, it's going to grow tax-free and you'll get to keep all of it. So there will be no taxes on distributions and no required distributions. The example that other people like me like to always give is about Peter Thiel of PayPal. He invested, or he took his PayPal stock, put it into a Roth IRA, and billions of dollars later, that money is all his, and it can't be touched because it's in this Roth IRA. So that's a pretty powerful demonstration of what a Roth IRA can do. Now, there's a lot of different things you can invest in when you're using a self-directed IRA. These are some of the more common investments that we see, but certainly not an exhaustive list. Real estate is going to be the most common asset that our clients invest in, and probably the clients of other administrators and custodians as well. And this is, just any of the things that you can imagine: SFRs, multifamily buildings, short-term rentals, um, projects overseas. There's a lot here that you can do, and it is a very, very nice performing asset inside of an IRA. Notes and mortgages, also pretty popular asset. So if you think about being the bank, how can you be the bank? Well, using your IRA is a path to doing so. You can structure your own loans. You can buy loans. You can participate in loans fractionally. A lot of different ways for you to use your IRA as a capital source for others and get, some attractive returns as that money is lent out. Next is private placements. So if you think about passive investments into real estate funds or investing into startups where there's a convertible note, for example, these would be another very, very popular asset class where we see people who are using IRAs. For example, investing in a company, the that might not play out. There might not be an exit from the company, or a sale of the company for 8 to 10 years, but investors say, well, I'm 49 years old. I'm not going to be touching that money for a while anyway, so I'll put it into this company and let it play out. So, very popular way for investors to be using their IRA money. And then last is going to be precious metals: gold, silver, palladium, platinum. So, another very, very popular asset class, especially as we have older generations who are setting up qualified accounts for younger generations. There are some things you can't do. Some prohibited investments include collectibles, so no baseball cards, no works of art, things that have this kind of high variability of valuation. You can't hold in your IRA. No life insurance or S corporation shares. There's certain derivatives and coins that you have to stay away from. And if you are thinking about doing something in your IRA and you're not sure if it'll work, you just give us a call and we'll tell you yay or nay. And if it doesn't work out, we can also kind of give you some ideas of how we've seen other investors participate in structures that might be to that asset class that you are interested in. There's also going to be prohibited transactions. So we'll start with no personal use. Now, if you had a property that you owned through your IRA, and let's say you're going to buy a house, you had a child going to college, you're going to buy a house for that child, and you say, okay, I'm going to have three roommates who are going to pay the IRA rent, and then I'm going to have my kid live in the fourth room. That will not work because your your child is not allowed to benefit from that property because it's held in your IRA. Now, if you had just four tenants living in there and none of them were related to you, then you'd be okay. But that's an example that we've seen people try to make happen, and they say, "Oh, okay, I'm gonna buy a house and I'll get rid of it once I no longer have a student attending that college." Unfortunately, that will not work. No self dealing, so you can't, for example, lend yourself a loan from your IRA. It's a question that comes up a lot. There's also no investing in selected family members. So kind of similar to that, the house example where you have the kid going to college. If your parents have a company, for example, and you wanted to invest in it, you can't do so through your IRA. Anyone who's of lineal ascent or descent can't be someone who can't benefit from your IRA. Now, you can partner with these family members through your IRA. So, what's an example? Let's say you and your daughter identified a mortgage note that you both wanted to participate in, and you were going to do it through your IRA, and she was going to do it through her IRA or through just personal funds. When you buy that mortgage note, you can buy it together. So split it up 50-50, for example. Let's say it was a 200K note. You do 100K in your IRA. She does the other 100K in her IRA. She does the other 100K personally, whatever it may be. You can partner up in that way at the time of the investment. So partnering is a great way to leverage your IRA with some of the people you know best in the world. So we've talked about what an IRA, self-directed IRA is. We've talked about the difference in the tax-deferred versus tax-free IRAs. We've also discussed what some of our common transactions are, as well as what you can not do in an IRA. So we've talked about all those things. Now let's see what an IRA in action can actually do. So this is a real deal that comes from Emerald Peak Solutions. It's the Butterworth Flats property. The investment breakdown contains numbers that are actually from this deal. So let's look at an investment of 100K. The term is going to be 5 years. The preferred return is 7%, and the equity multiple is 2x. That gives us a cumulative cash flow of $35,000, an equity share of $65,000, and a total net return of $200,000. And that's the total net return, including the principal that you originally put in. On the right side is this investment through just regular personal funds. You're going to get hit with income tax. It's almost $13,000. It's going to be capital gains tax, $13,000. There's also going to be depreciation recapture tax. So the common benefit, or the very attractive benefit of investing in real estate, is that you can get depreciation. You cannot get that depreciation when you use qualified funds, which are self-directed IRAs. But even in the personal fund scenario, if you're getting that depreciation, you're going to have to pay some of it back through the depreciation recapture tax when the property is liquidated, and that's almost $13,000 too. So all said and done, you're going to keep about 61 grand from that original return. So now let's look at this investment through qualified funds, in this case, a tax-free Roth IRA. There's going to be no income tax. There's going to be no capital gains tax. There's going to be no depreciation recapture tax. There is going to be unrelated business income tax, and I'll pause here just to talk about what that is, unpack it a little bit. So unrelated business income tax, also known as UBIT, is effectively a mechanism for the IRS to assess some tax, because the IRA is really operating outside of the scope of what the IRA was intended to do as a passive investment account. So in this case, the unrelated business income tax is being assessed because there was leverage used in this real estate project. Now, just as you can use your regular cash and get financing that will expand your buying power, so too can you use leverage in an IRA to increase the buying power of the money that you have there. But this again is kind of beyond the scope of what was intended with these IRAs, these retirement accounts. So the IRS is assessing some tax because they want to account for the money that was taken out of circulation in the financing world that benefited this IRA. Now, I'd say there's two positives to look at here. Number one, we don't like tax, and you probably don't like tax either, but this tax is, again, a mechanism for allowing the IRA to use leverage. So alternatively, the IRS could say, no, you can't use any kind of leverage through your IRA, which would really reduce the number of opportunities that you could participate in through an IRA. So the fact that you're assessed some tax is a benefit because at least there's opportunities still for you to participate in deals that either use leverage, or if you use leverage through your IRA directly when you're buying a single family home or something. The second thing to note here is that the UBIT is only going to be assessed on the amount that of the return that corresponds to the size of the loan. So the loan used in the projections here is a 70% loan to cost. So only 70% of the gain is going to have that UBIT assessed. So and you can actually use some of the depreciation because now that 70% is being treated as kind of more normal income. You actually can use some depreciation to even reduce that tax liability. So it's not all bad. Some people get a little bit scared when they hear about this whole UBIT thing. We look at it as, hey, it's better than the IRS saying you can't use leverage at all and you have to pay some tax, but do your due diligence ahead of time and make sure that the um, a UBIT liability isn't going to be too great, and it could actually turn out to still be a great deal. And in this case, that is the case. Even with UBIT, you're still going to come out ahead almost $30,000 versus using regular cash to personal funds to invest in this deal. So I've talked to you about everything about the different kinds of investments you can do. Now let's go through how the process can work. So to get started with CamaPlan, you're going to open up and fund your account. It takes about 15 minutes to open your account online. You're usually going to roll over or transfer money from an existing custodian like Schwab, like Fidelity, and use some of those funds to put into your IRA. Once your funds arrive, you can fund your investment. So you fill out what's called an asset purchase directive, which tells us where the money's to go. We sign all of the necessary investment paperwork on behalf of your IRA, and then the money is wired usually within 48 hours, and the investment is funded. And then any kind of money that comes back from the investment, like any distributions, rental income, that goes back into your IRA. What do we do exactly? Well, we are checking the box of being a required third party by the IRS to be able to hold these accounts. So compliance is our number one responsibility. But above that, we're going to be a part of your financial team. We want to be there to hold your hand and hold the hands of your advisors, your attorneys, your accountants, so that everyone's on the same page about how this will work. And that means that we'll spend time with everyone, no matter how long it is, so that they understand exactly how this is going to best serve your strategy. And we want to enable you to be able to achieve true diversification by you using your retirement capital to invest in alternative assets. And since this is just a recording, we can skip right past the questions. Here's the contact information for Cindy if you have any questions about her deals. And then here is contact information for CamaPlan. That QR code will get you some discounted pricing on our accounts. So typically the account setup fee is $75. We'll actually reduce the account setup fee to just $1. Thank you very, very much for spending some time watching this presentation. If you have any questions, you can reach out to CamaPlan at that email address and phone number, and we'd be happy to help you out. Again, thank you very, very much.